Queensland federal budget's just around the corner. There's a lot of concern with splashing of cash from desperate governments to try and, will it make inflation worse? And interest rate rises, that sort of stuff. Is the fear grounded in any reality, or is it not true? Let's ask a friend of the show, the unconventional economist and founder of macro business Straight Shooter, Leith Van Onselen. G'day, Leith.
G'day, Bill. Thanks for having me on again.
Good to talk to you, mate. Look, Aussie workers, they're bearing the brunt of the inflation. We know that, or as you call it, elbowflation. What do you make of all the commentary at the moment regarding the pre-talk of Jim Chalmers' budget, and will the spending lead to fueling inflation? And it's risky.
Yeah, look. It all depends on how the spending's done, right? So, if you just give Australian households a whole bunch of money, they're going to obviously go out and spend it, and that can be inflationary. But if it's designed properly through targeted subsidies, it doesn't have to necessarily increase inflation, and it can actually bring down inflation. So, for example, we know that a couple of the biggest drivers of Australia's inflation is property rents, as well as things like energy. And so, if the federal government, or in your case, the Queensland government, with their commitments, actually targets those two areas and subsidises the areas which are helping to drive inflation, it can actually lower the CPI and actually lower inflation. So, for example, obviously, your state government has just promised to cash splash on energy rebates, and those are actually likely to lower inflation across the country. And the reason for that is the last round of energy rebates, not just from Queensland but also Western Australia, they actually reduced energy prices in the CPI basket by about 10%. Right, so that actually helped to lower inflation because it lowered energy prices, which then led to lower CPI. And I'd also argue that it's actually a good use of funds, because I think I spoke to you last time, Bill, when I said that it is absolutely absurd that Queensland, being an energy superpower that exports far more coal and gas than is used in your own energy generation, your electricity generation, etc., was basically paying close to global prices for those things. Really, Queenslanders should have some of the cheapest energy in the world, because you're swimming in energy. You're swimming in coal, you're swimming in gas. And the way I look at it is that these energy rebates, they're being paid for by the 2022 budget increase in coal royalties, right? So they're actually, I look at them as a dividend from the multinational coal firms back to Queenslanders on some of those record export revenues that they've made through selling that coal overseas. And I'd argue that lowering Queenslanders' power bills is actually sensible. It's actually, you should have cheap power up there, because you're swimming in resources, you're swimming in coal, you're swimming in natural gas. You should have some of the world's cheapest energy prices.
Even as a one-off and not as a permanent solution. So, because you're on a completely different page to another economist up here, Gene Tunney, who said we can't afford it because of all the revenue streams, because coal royalties, we can't afford it because we'll be paying for it overall. I think it's a $2.5 billion costing. He said we can't afford it, and we'll pay for it in the long term.
Well, no, not necessarily. I mean, my view is the state government should also be extending royalties against gas, because you export the overwhelming majority of gas, you export it overseas to China, right? My view is that Queenslanders, and indeed Australians, this is more general, should be capturing more of those benefits. So, for example, Norway collects about 80% of its profits on its oil and gas exports goes to Norwegians, because they have effective 80% tax rate. And part of that's because, some of the gas companies are publicly owned, but even if they're privately owned, they have to pay enormous taxes. And as a result, Norwegians are sitting on a sovereign wealth fund that is worth $250,000 per citizen. They're incredibly rich through their mineral wealth. We don't do that in this country, and I think we should. So my response to that economist is, why doesn't the Queensland government extend the royalties on gas? It should also have a domestic reservation scheme. So just like Western Australia does, it should require that 15% of all export gas is reserved for residents. And it should also put price caps on that gas, because Queenslanders should not be paying high energy prices when they literally export well over 80% of their coal and gas overseas And why are we giving the rest of the world cheaper energy than what we pay at home? It doesn't make any sense. And look, but to your point, it is obviously a Band-Aid solution, right? It's a one-off.
Yeah.
It's a two-off because it happened last year as well. And effectively, we need fundamental reform to basically bring down energy prices for the long term for local residents. But that being said, the whole notion that this is going to be inflationary is just wrong, because it's going to directly lower energy prices, which are one of the key components of the CPI, and it should actually, counter inflation.
So there's no risk, because it's no risk someone will get, well, the $1,000 has gone in, that's great, that'll look after the power bill. Oh, that money I haven't got to put into I might go and spend it somewhere, and it's only a one-off, so there's probably no great risk of that. Yeah,
look, sure, there'll be some spillovers to other areas, but using that same logic, you could argue that higher petrol prices isn't inflationary, because if you've got higher in petrol prices, you can't spend that money somewhere else, so therefore you don't spend it somewhere else.
Yeah.
So, it's a bit of a circular argument. Using that argument, pretty much any price rise from anything isn't inflationary because it takes away spending from somewhere else, if you get my drift. So,
yeah, gotcha.
So the fact of the matter is, rebates on things like energy, things like rents, where there's obviously hyperinflation, can actually tame inflation at the margin, but they're not fixing the underlying problem. I will admit that. So obviously the rental problem, for example, has been driven by, extreme levels of net overseas migration. And to solve that problem, you're better off cutting immigration, cut it to sensible, sustainable levels, cut it to a level that is below the nation's capacity to build houses and infrastructure. That is the long-term fix. But, in terms of just a short-term cyclical fix, a Band-Aid, it's not necessarily going to stoke inflation. In fact, I'd say it's actually going to lower inflation, these sorts of things. But, it's not a long-term solution. It's a one-off fix. It's a short-term one-off, fix, a Band-Aid.
Yeah, no, it's a Band-Aid, and it's not going to have any impact on inflation. All right, so it's a bit of a tick for the government's move on this one. I think they've doubled from the last rebate they were providing. Where do we go with the RBA and rates now moving forward? There's, again, conflicting views on whether rates will go up again, whether they'll stay where they are, when there may be a cut on. Where do you see all those sitting?
Yeah, look, I'll admit it's been a hell of a week, hasn't it? So a week ago we had higher than expected, inflation figures, which obviously led to a whole bunch of economists saying that rates are going to go up next. And it was led by Warren Hogan, who said we're going to have 3 rate hikes this year. However, I think that commentary was a bit reactive and a little bit too, was way too hawkish in my view. Mm-hmm. And I think it was pretty much shattered this week by the appalling retail sales numbers that came out. So retail sales unexpectedly fell by 0.4% in March. Economists expected a 0.2% rise. They're up only 0.8% year on year. Now, you might be listening to that and thinking, 0.8%, that's still growth. Problem is, it was the lowest annual retail sales since 2000 outside of the pandemic. It was also, once you, subtract population growth of about 2.5% and inflation of 3.6%, it means that basically real per capita retail spending declined by 5% in the year to March. So that comes off the back of a world record decline in household disposable income. So Australian households went backwards last calendar year by 6% in the real disposable income. That was the biggest fall in the world. And what this basically tells you is that the household sector, which drives 60% of the nation's growth, is incredibly weak. And it's weakening fast, and it's weaker than economists and the Reserve Bank would have expected. And what I think that means is that the Reserve Bank's going to be very reluctant to increase rates into basically a household sector that's in deep recession. And I still think the next move in interest rates is down, although I think the timing of those rate cuts have obviously been pushed out by the latest inflation data.
Yeah. With just quickly on our house prices before I let you go up here. So I think we overtook Melbourne this week in terms of the median house price up here. And you know what the situation is with housing available around the country, but particularly up here at the moment for our listeners. It's not going to improve, is it? We're going to be hitting $1 million as a median house price, which you had have said that a few years ago, people would have laughed at you.
Oh, it's absolutely absurd. So according to PropTrack, Brisbane house prices have gone up about 65%, I think it is, since the March 2020. So that is absolutely enormous growth. And your overall median is now higher than Melbourne. Your house price median is only 1,000 less than Melbourne. So by the end of this month, you're likely to have overtaken Melbourne. And look, it is extreme growth. My bigger concern is obviously the rental market. I've seen tent cities explode across Queensland. I've seen lots of photos and everything about that. You guys are living that up there, and essentially it just gets down to too much population growth for the amount of homes that we can build. And obviously, it's a bit different. Sydney and Melbourne get most of our population growth from overseas, and then Sydney-siders and Melbourne people then leave because it becomes unlivable down here, and then we end up going to Brisbane. And that just creates a problem up there. So it's a sum of too much population demand and not enough supply. We can't build homes. Housing construction's at a decade low. It's falling because of high costs. Builders having to compete for labour against infrastructure projects, all those sorts of things. And because of that, housing construction is constrained at the same time as the government's just ramming in record numbers of people. That's effectively the problem.
Perfect climate as we're seeing up here this week for CFMEU, the unions like that are in the driver's seat. They've got the government's over a barrel because they need to build stuff, and no wonder they're going on strike and seeking exorbitant wages and conditions. Yeah,
it just means the situation's going to get worse. So if you're a tenant in Queensland, it's obviously a horrible situation you're in, and I think it's just going to get worse, unfortunately, because the population demand's just running so far ahead of the rate of being able to build homes, and it's just going to keep getting worse, unfortunately.
Yeah. All right. Great to talk as always, Lee. Thanks for your time, mate.
Yeah, thanks, Bill. Speak to you next time.
Yeah, Leith Van Onselen, the unconventional economist and founder of Macro Business. I like Leith. He talks a lot of great sense, and he busts it down nice and simply for everyone to understand.